Long, publisher and editor of GordonTLong.com and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As usual, I have John Rubino back with us on a monthly basis. John is well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back.
Morning, Gord. Good to be back.
Anything new and exciting in your world before we jump right into negative interest rates?
There's always lots of new and exciting things going on. But I think the negative interest rate thing is what we should definitely start with.
Well, you've written two articles which prompted our discussion to do this. One is on gold in a negative interest rate world, and now watch Denmark specifically. So why don't we start there with what the key messages were there? Because even since you wrote those, there's been some new developments.
There has. Well, basically, the world has borrowed too much money, which we all know and we've seen happen over the last decade. But now we're reaching the point where the normal response to being over indebted and having your economy slow down because of that debt is to lower interest rates to get the economy moving again. Well, we've been doing that year after year after year until we reach the point where 90% of the developed world now either has zero interest rates or negative interest rates at the central bank level. And so we're reaching a point that is really unprecedented in financial history. And we're seeing a lot of distortions because of that. And that's really the story now, is what is happening around the world as interest rates drop to these absolutely unprecedented levels, and how the financial markets are reacting to it. So right now, there are about $2 trillion of negative interest rate bonds in the world. In other words, you have to pay these guys in order to lend them money, whether it's a government or a major corporation. And so at the central bank level, the European Central Bank, the Swiss Central Bank, Denmark and Sweden all have negative interest rates. So if we want to lend to those countries, they don't pay us, we have to pay them. And that's spreading to the corporate bond market now, where BMW and British Petroleum and Nestle, among others, now have negative interest rate bonds. And the distortions that flow from this are really the most fascinating story that's out there right now. So, for instance, just take a couple of examples. If you're a corporation and you can borrow money for a negative interest rate, in other words, if money is better than free, and your stock is yielding, let's say 2%, that's the dividend yield on your stock, it makes a lot of sense for you to borrow huge amounts of money at negative rates and then buy back your stock with the proceeds and make that spread. You don't have to pay your dividends anymore. So you save 4%, or you make 4%. It's a cash flow positive activity. And so no surprise that we're seeing huge amounts of share repurchases, especially in the US stock market, but also around the world. Right now there's about $400 billion a year being bought back by corporations of equities. And that's what's underpinning the stock market. That's the main inflow into US equities. And it's working. It's pushing up stock prices, and has been for the last few years. So that's just one really strange distortion that comes from negative interest rates. And there are lots of others that we can talk about as we dig into it.
Yeah, these negative interest rates, how do the pension plans, how does their model work? How do insurance companies' model work? How do money markets now work, which is the underpinning of the European market banking system, is money markets, where you've now got a real movement to these negative rates. Those are busted. How do they stay alive? And maybe as important, how do they pay out their pension obligations?
Well, that's the question, because they are all based, their business models are based on positive interest rates. They take in money from whoever it is that is investing with them, and they then invest that money in mostly fixed income instruments at higher rates than they're paying out. And that's how they grow their assets, and that's how they make money over time. But if you impose negative interest rates on those sectors, then, for instance, pension funds have been based on the promise of an 8% return on their investments. Well, if you're getting minus 1%, let's say, on your fixed income portfolios, how do you generate 8%? You either can't, and then you can't make the payouts that are due when they come, or you have to go way out on the risk spectrum and invest in, for instance, junk bonds and equities, which, you know, in good times will make you more than 8% in a year, but in bad times will lose you 20 or 30%. So your risk profile, which used to be very conservative, if you're a money market fund or a pension fund or an insurance company, that changes. You become a hedge fund. And so you do well in good years and terribly in bad years. And that alone is a really destabilizing factor in the global economy, because these are big industries. You know, there are tens of trillions of dollars in the industries that you just named. And for them to shift from being the safest possible places to put your money to being hedge funds is a huge change in the world. And I think it's not really well understood by most average investors, right? Because most people still think a money market fund is like cash. It's where you park your cash to keep it safe until you need it again. Well, that's not going to be the case going forward if money market funds have negative returns, because they're based on, the buck. They're based on always having the same value over time. And as soon as they start losing money because the stuff they're investing in is generating a negative return, then it's not cash anymore. Then it doesn't hold its value over time. And all of a sudden, it's a completely different industry. And so, yeah, we're seeing that across the board. And people don't get it yet, but when they do get it, then that's going to add to the sense of panic and mistrust that is already growing in the global financial markets. So any one of these guys, a big pension fund blowing up, a money market fund crashing and burning, an insurance company, turning out to be mostly a derivatives-based hedge fund, like with AIG in 2008, any of those things could cause the financial market to shift from risk-on optimism to risk-off pessimism in a heartbeat. And so that's the kind of potential that we're building into the market now. And people don't really get that yet, but they'll get it when the time comes.
There's some very good diagrams that show that when you push liquidity out, how it changes risk and price, and it will sustain itself. But the moment the liquidity slows just a little, it's a waterfall straight down. So the question is, what would stop slow liquidity, like a taper or whatever? But remember in 2008, John, you remember quite well, what it all blew up was the short-term money, what was then the asset-backed commercial paper, money markets, but the short-term money, because the banks, the whole gig is to borrow short and lend long, and so you're rolling on the duration. Well, we have a $72 trillion global shadow banking system that's living that way. You start inserting negative rates in there and changing these models that the pension plans and insurance companies live off, you're on a hairy edge. And I saw statistics the other day that all the credit in the United States, and you and I have talked about this, is car loans and student loans, which are funded and backed by government agencies. It's not private sector money that's there. So what I'm seeing, John, is that we've pumped up so much money that's out there with this liquidity, and what it does when interest rates are cheap, it allows a consumer. We have a 70% consumption economy now, but we're at an elevated consumption level because of cheap money, low interest rates, and we're kind of running its course as America gets tapped out. But that money was also cheap for corporations around the world to borrow and expand supply and capacity and manufacturing, which they've done. Now all of a sudden they reach an equilibrium point, but it's at a very high level, and you've got to sustain it. And if the demand slows or doesn't accelerate, the supply is over capacity and they have to cut. Then you get commodities not being needed. You see all these things like the Baltic Dry, etc., saying demand is falling off, and they have to pull in their horns. And then we have a $9 trillion U.S. shadow or carry trade that's financed a lot of this, where they're on the wrong side of the deal with slowing businesses. These are ingredients for a real problem. But I need to make one last statement. Don't for a moment think that it's about to blow up, because just like we would have never believed there would be such a thing as negative interest rates what are we talking about today? And a year and a half ago, we would have said that was absurd.
Yeah, the idea that the whole world is going to negative interest rates is a pretty crazy idea when you think about it. You know, that turns the basic theory underlying global finance on its head. And so the consequences are pretty hard to predict because we've never been here. You know, we've never had this complex, this indebted, and this strange a global financial system before. So yeah, you know, we could spend hours talking about the distortions that flow from easy money that are just magnified by negative interest rates. Because you mentioned the global dollar carry trade. That's a fascinating one right there, because basically what happened in the last 5 years is that a big part of the developing world borrowed a lot of dollars at fairly low interest rates, thinking it would be a good deal because the dollar would be kept low by U.S. easy money. And they used it to build infrastructure. They built roads and bridges and factories and expected to generate enough free cash flow from those things to pay off the debts. Well, the value of the dollar just went through the roof in the last 6 months because we have tried to withdraw from the currency war briefly. In other words, we're trying to scale back the amount of debt monetization that's going on, the amount of money printing that we're doing, and the amount of money that we're pumping into the banking system. Well, that's caused the value of the dollar to go up relative to the euro and the yen and most other currencies. And now all of a sudden, all these dollar loans are underwater. You know, $9 trillion is a huge amount of money. It's bigger than China's whole economy. And to see that magnitude of debt be pushed underwater, in other words, to see all these projects become cash flow negative, is pretty terrifying. You know, we don't know which of those things is going to blow up first, but if the dollar stays strong, and if it gets stronger from here, we're going to see developing world projects start to blow up on a vast scale, and developing world governments become less and less solvent. So that alone could be the catalyst for the next financial crisis. And that's just one thing. You know, we mentioned pension funds and money market funds and insurance companies before, and now we've got the dollar carry trade in the developed world, or the developing world. And either one of those things are big enough and unusual enough and scary enough to cause the financial markets to shift into defensive mode. And with everything priced for perfection out there, you know, U.S. equities, Japanese equities, they're at all-time records. And Chinese equities and European equities are way up. So these things have air pockets underneath them. And let anything happen out there right now to spook the financial markets, and you'll see a lot of major equity markets just tank. You know, and that's because that's how it works. You know, you get past record territory, and you're just kind of waiting for something serious to happen. And in the past, something serious has always happened. You never pass record levels and then just keep on going. That's very seldom the way the world works. And so we're entering a stage now where it's a lot like 2006, 2007. All kinds of distortions out there, all kinds of money being lent that shouldn't have been lent, and the financial market's priced for perfection. So it's a catalyst watch. You know, something will blow up in the near future, and that'll change everything. We can't know what it's going to be. We can't know when it's going to happen, but we've created the conditions for it to happen, and so therefore it will. Borrowing money is basically stealing from future growth, right? And so we've been doing that for 30 years, and so we're reaching the point where it's hard to use borrowed money to create new value just because it's been done on such a vast scale already. And so, yeah, it's hard to run a small business now because your customers are largely tapped out. You know, they've got student loans, they've got a mortgage, they've got a 7-year car loan. And so what's left for them to buy your stuff with? Not much. And so to the extent that small businesses are basically discretionary product marketers, you know, they're selling things that you don't necessarily need, but you would buy if you had some spare cash. Well, you don't have as much spare cash anymore because you've already borrowed a ton of money to buy the things that you thought you needed in past years. So yes, it's really hard to start and maintain a small business now. And the governments of the world are responding to that by lowering interest rates into negative territory, as we said, and it's not working. That's the really scary thing. So we got down to zero interest rates, and we didn't ignite a global out-of-control boom, because that's what you would expect normally. And in the past, anytime interest rates got fairly low, the markets reacted by borrowing a ton of money and spending it on all kinds of things, and igniting a boom that then led to problems which the Fed had to address by raising interest rates. Well, that's not happening. That's not happening anywhere. There's no out-of-control boom anywhere in the world, which means low interest rates don't really work anymore. And so negative interest rates, by implication, probably won't work either, because they cause a lot of distortions that end up slowing the economy down, which we've already talked about. And so it's not clear what the solution is to any of this. Keynesians, you read Paul Krugman's columns in the New York Times, and his attitude is that, well, we just haven't borrowed enough money yet. We haven't pushed interest rates down as far as we need to. So more of the same will eventually reach a point where it does work. And that's what's going to be tried. So we will see in the next year or two if 5% negative interest rates and budget deficits of 15% of GDP, if those things work to bring us back to sustainable growth. And my guess is that it definitely won't work, because we've already borrowed so much money that more debt, rather than generating growth, slows down growth. It becomes a burden. So they call that the marginal productivity of debt, and our marginal productivity of debt is at zero or negative right now. We borrow more money, and instead of generating growth, it slows growth down. And so where we go from here is apparently more of the same. We're going to cut interest rates even further. We're going to increase money creation to an even greater extent, and it looks like that's going to cause things to spin out of control at some point. And the question is how. We've never been here, so we don't know exactly what's going to happen, but we know a crisis has to flow from all of this. And one of the interesting things that we haven't talked about yet is what that means for gold, because when crisis leads to a demand for safe haven assets. In other words, when things are really dangerous and really unpredictable, you want to go to things that are predictable. Even if they're not going to make you a lot of money, they won't lose you money if you choose wisely, when you're buying predictable assets. And gold has historically been that kind of a predictable asset, but it also came at a cost. If you were going to buy gold and pop it into a vault for safekeeping, you had to pay, let's say, 1% a year storage fees. So gold was actually a cash flow negative asset. And when you compare that with, say, high-grade government bond, which used to yield like 6%, the bond looked like a better deal, because you were buying a safe asset in a treasury bond or whatever, but you were generating cash with it at the same time. So it was a more logical decision for most people, for instance, pension funds and insurance companies, to buy the asset that was going to generate income for them. Well, now with government bonds yielding negative 1% in a lot of cases, and gold still charging you 1% for storage, you've got these two safe haven assets, both of them slightly cash flow negative. And so you would think that people are going to start looking at those two sets of assets, the two in the long run, because it has held its value since the days of the Roman Empire, and government bonds, because they pay you in fiat currency, are you're going to get your fiat currency back. So there's not a payment risk with the treasury bond, but there is a currency risk. And no fiat currency has held its value over long periods of time. So you've got to figure that more and more people are going to conclude that with both assets being cash flow negative, that gold is the better bet. And so that's another question. When does that get going? At what point do people realize that fiat currencies are inherently flawed and are charging you for the privilege of owning them, and start switching to other kinds of assets? You're seeing that with the 1% right now buying fine art. Van Gogh is something that has held its value over long periods of time. And so is farmland, and so are London penthouses and Manhattan condos. These are the kind of things that rich people are putting their money into right now, and they're doing that because those things seem more trustworthy than fiat currencies, even though those things cost you money in the short run to own. You have to store a Van Gogh, and you have to pay to protect it and to maintain it. But that still seems like a better deal than treasury bonds, which you also have to pay to own. So that's going to be an interesting dynamic going forward, and that's something we should pay attention to. And we'll know, if the price of these hard assets continue to rise, then we'll know that process is getting going, and that it will eventually spread to precious metals. So yet another reason to choose gold over dollars.
I had an interview yesterday with Dr. Mark Faber, and his words were on this subject that it's now presently irresponsible not to own gold. that was his words. The tape is up on the library. And I also interviewed Dr. Lacey Hunt, one of the biggest bond people in America, the Huntington Group in Austin, Texas. And he was talking about, with negative interest rates, it'll be smarter for companies to hold cash, in that they would pay their employees in cash envelopes versus using the banking system, and they'll use their own vaults. And it starts to change a whole pile of the dynamics. And it says, well, why would this happen? Why would we? And that's a whole discussion in itself. But I had another discussion with Richard Duncan on this subject, and Richard showed me some very interesting charts. It says, Gord, he says, right now the United States, the Federal Reserve is buying all the treasuries. We all know that, to the point there's a shortage of treasuries. Well, they got all those treasuries. So who pays them to sit on the treasuries? Well, the U.S. government, the U.S. Treasury pays them, so they get the money. And it's about $80 billion and even higher. They turn around and then return all of their profits, which is the vast majority of that, with a little bit of administrative, back to the U.S. Treasury. So effectively, they're zeroing out the debt. So they're removing all the debt from the U.S. Treasury debt from the market. And as long as they never do anything with it, all you have is a accounting transfer here. I pay you, you pay me, and everything sits. So these bonds may sit until they expire, right? Then they roll it over. They don't pay it out, and effectively, in many ways, there's a gig going on here to remove the debt. Now that doesn't work, but it does if it's in a very orchestrated ring around the rosy with the developed countries, where they're all kind of playing part of that game. And and where does the money come from? It's coming out of the savers and pensioners and people who were getting income. Now they're getting no income, as purchasing power is completely and totally stripped from them.
Yeah. Well, there's a monetary theory that says that the whole idea of government bonds is just a needless complication, that governments should operate by just printing the money that they need, just creating it and spending it.
Well, we wrote that into our Constitution. we came to that conclusion when America was formed, and the first set of presidents were very, very clear on that. And if you ever lose control of directly printing the money and funding it, you will lose your country.
Yeah, but the Constitution also said that we can't create money out of thin air, that money was gold and silver, and that in those terms, we would have to go get money. We couldn't just print it.
We would have had to have produced more than we consumed.
Yes,
gold.
Yeah. And so now the newer version of that theory is that we just eliminate the whole concept of government bonds and just print the money that we need. And the flaw in that theory, of course, is that the money that we need, quote unquote, is a very elastic concept. And once you're able to create as much money as you want, then your needs expand exponentially, right? And so giving the government that kind of power just means that we'll inflate away the value of the currency that much sooner, because they will abuse that privilege on such a vast scale so quickly that we'll have a version of a hyperinflation pretty much right away. So that the theory doesn't work. But what you just described with the Fed buying back bonds and then paying the interest back to the government is basically that. We're doing it in a backdoor fashion with a couple of accounting steps in between. But really what's happening is the government's just creating as much money as it thinks it needs. And so we're testing that theory, that's the way the government should operate. And, it's being found wanting already. The whole system is beginning to spin out of control if you define negative interest rates spreading around the world is out of control, which I think you should.
Or we're mutating to a whole different framework, because we can see that discussion we just had with the Fed. But I was talking to Dr. Steve Keen in London, and we always talked about helicopter money, and Bernanke talked about it, and we all know that it's just absurd. But what he's talking about, and he's a leading global economist, that we're moving to helicopter money, and by that, instead of it being going out through the banks, it being directed to groups, money going out from the government directly to groups, and so that it bypasses the banks, puts it into the economy, stimulates the consumption, or helps with effectively the debt. How could that work? Well, blatant example would be if we suddenly paid for student loans or student debt, and said, okay, forgiveness of all the debt. Or if you you have the debt and you work for the government for so long, it's all paid off, and that's where the money goes to pay it off, which effectively is government kinds of work. I know in my area, we're now offering that if you do community work for our towns and the various towns around here, they will give you $1 of value as a tax discount. And effectively, it works out to about $15 an hour. So you got everybody that's doing work, shoveling snow or whatever, because they get a tax break. That doesn't cost the government anything. It's not effective. They're not paying it out. They're reducing a tax of money you might have given. But you can see where more and more of this employment could go to the government, and the government could be directing this helicopter money. Do I think that's the solution? No, I'm just listening to people who are in the know, and the thinking is going that way.
Well, Steve Keen's thing is basically the debt jubilee.
Yeah, he really does believe that. And for years, for the Syrian generation, for years, that was the way. 49 years, they solved this problem. Not quite this magnitude, but conceptually, you're right. That's a biblical, historical concept where every 50 years or so, the government would just decree that borrowers didn't have to pay back their loans, and that's we could never do that now, but the governments could do it in another fashion. Well, but I don't give them enough credit for a moment, John, here, that I think they've got this planned out.
Well, no, they're drifting
or a
into
scheme.
it.
It's tripping and stumbling and following with lack of direction into something that they think will work, and as bad as all these plans are. Some of this stuff we said this is the next step, and sure enough, that's what happened. Even though we said it was totally, you and I were talking about being wrong, but that's the stumbling road that we're on. And so I could really see us with direct helicopter money within 24 months to offset a new crisis that's emerging.
Sure. Well, and you're right. They don't have any master plan here. They're doing what it takes to get through the next month, basically, and then at any given time, they're looking at their set of options and going, all right, well. Lower interest rates is the least dangerous thing that we have on our plate right now. So let's do that. And they've been doing that for 6 or 7 years now. And since they really cut interest rates in 2008. And there's no end to this on the horizon because there's no other option out there that isn't incredibly painful. We're seeing it in the US right now. What happens when you try to stop? We haven't cut interest rates for quite a while. We've scaled back quantitative easing a bit, and the dollar has shot up versus the other major currencies, and the dollar carry trade is blowing up out there in the world. So let that come back to haunt us. For instance, let corporate profits start to fall because a stronger dollar makes it harder for us to sell stuff to the rest of the world, and then let the stock market crack because corporate profits are going down, and you'll see us go right back to quantitative easing and lower interest rates and the whole thing, because that's the only option that we'll have. We can't have a financial crisis now because we can't afford it. We're too financially fragile. So anything that shakes confidence in what is basically a Ponzi scheme right now and causes less capital to flow in to pay the old debts that need to be paid off blows up the system. So exactly. Yeah, so that's where we are, and we're drifting further and further into debt jubilee territory. And you're right; it's going to be explicit at some point. Right now, it's implicit and it's piecemeal. We make student loans easier to pay off, and we make mortgages easier to get and cheaper, and in that way, we're in effect giving money to people. We're printing it, giving it to people, and that's kind of behind the scenes, and it looks like the government's just there to help you and got your back and everything. But it'll be explicit at some point because it has to be broad-based to manage a financial crisis. And then it'll be helicopter money, and then it'll be a debt jubilee. And all of this stuff is coming. And so the question is, what happens once governments are completely freed from the need to defend their budgets and to pretend that deficits are bad things? And I think they'll just let fly when the time comes. You know, they'll monetize every piece of debt in sight. They'll finance anything that moves, and then we'll get the crack-up boom. But it's taken a lot longer to get there than I would have expected. You know, it seemed like the numbers didn't work really in 2000, and then certainly in 2007, 2008. But we survived.
Well,
and now the numbers.
It's amazing what $53 trillion will do.
Yeah. and yeah, you're right. We did it by borrowing really obscene amounts of new money.
Fascinating discussion, John. Yeah. We could speculate on all of this, but we will. We'll be back next month speculating again, I'm sure. But to our listeners, this is just us speculating here. There are no recommendations are being made or advice given, just simply opinions from those who are watching. John, closing comments, and how could our listeners learn more about your work and your writings? Well,
I run dollarcollapse.com, which is a site that covers a lot of the stuff that you and I talked about. And my most recent book is The Money Bubble, What to Do Before It Pops, co-written with Gold Money's James Turk. That's available on Amazon and on dollarcollapse.com and other electronic bookstores.
Talk to you again next month.
Thanks, Gord. Yeah.
Always a pleasure. Bye.
See ya.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.